It's time to pay attention. There's a massive global economic shift happening right now. The way that the world transacts and moves money is about to fundamentally change. We're talking about a regime change that occurs once every century. Economic students will be studying and writing about the events of the next few months for centuries to come. Think about the move onto or off of the gold standard. The move from paper-based open outcry trading floors to digitized computer-based markets. The invention of the internet and the dot-com era. That's the level of significance that we're talking about in terms of these global economic changes. There's a once-in-a-lifetime chance to take advantage of this and create generational wealth. Your children, your grandchildren can have financial stability if you make the right moves over the coming months. But you have to pay attention and get your strategy right. If you miss this opportunity, you won't get another chance. This is the most important breakwater moment that we'll see in our lifetimes. I'm here telling you why you need to be paying attention right now and what you can do. And the answer is in blockchain technology.
This move is almost unprecedented in how fast it's occurred, but it's not just Bitcoin.
So first off, let's start with the basics. What is a cryptocurrency? At its core, cryptocurrency is a form of digital virtual currency that uses cryptography for its security. Unlike traditional money issued by governments, also known as fiat currency, cryptocurrencies operate on a technology called blockchain, making them decentralized and transparent. But what does that mean? Imagine a ledger, a record book of all transactions that's not held by any single bank or government, but distributed across countless computers around the world. Every time a transaction occurs, it's recorded on this ledger. When the ledger, or the book of transactions, is full, it gets added to the library of books in a linear, chronological order, and we move on to the next book, creating a chain of these ledgers, known as a blockchain. This means that once a transaction is recorded on the blockchain, it can't be altered or deleted. Cryptography ensures that the transactions are secure and that only the intended recipient can access the funds. But cryptocurrency isn't just about digital money, it's about the potential to revolutionize various industries by introducing transparency, security, and efficiency into systems that have remained unchanged for decades. To understand why now is a crucial time to pay attention to cryptocurrency, it's useful to go back and understand a bit of the history. Let's take a moment to highlight Bitcoin, the original cryptocurrency that started it all. In 2009, an individual or group known as Satoshi Nakamoto introduced Bitcoin to the world. This groundbreaking innovation offered a new kind of money, digital, decentralized, and operating on a peer-to-peer network without the need for intermediaries like banks or governments. Bitcoin wasn't just a new currency, it was the birth of blockchain technology, a secure, transparent ledger system that underpins all cryptocurrencies today. As the first and most prominent cryptocurrency, Bitcoin set the standard and became the benchmark for the entire crypto market. Its influence is so significant that its price movements often dictate the overall market trends, a phenomenon known as Bitcoin dominance. When Bitcoin's value rises or falls, other cryptocurrencies, known as alternative coins or altcoins, frequently follow suit. All the other cryptocurrencies you see in the market today were designed based on Bitcoin's original blueprint, but with specific features or enhancements that make them better suited to particular use cases. For example, some coins focus on payments and settlement, while others focus on supply chain management, gaming, or decentralized finance. But they all evolved from a common ancestor. Several factors contribute to Bitcoin's pivotal role. Bitcoin has the largest market capitalization across all the cryptocurrencies, with $1.9 trillion of an overall $3.5 trillion across the whole market, making it a significant indicator of market health. With a capped supply of 21 million coins, its scarcity is akin to a digital gold, which serves as a hedge against inflation. Bitcoin enjoys global recognition as the most widely accepted and recognized cryptocurrency, with increasing adoption by individuals, businesses, and institutional investors alike. Understanding Bitcoin is essential because it sets the foundation for the entire cryptocurrency ecosystem. Its protocol includes a unique feature known as the halving, which has profound effects on its value and by extension the entire crypto market. So what exactly is the Bitcoin halving? The network operators that confirm the transactions on the blocks are known as miners. Miners solve complex mathematical problems in order to build the ledger and get rewarded for doing this by receiving payouts in Bitcoin. The amount of Bitcoins that get paid out are periodically cut in half. This occurs every 210,000 blocks, or approximately every 4 years. The halving mechanism is built into Bitcoin's code to control inflation by gradually reducing the number of new Bitcoins entering circulation. Each halving has historically led to significant market movements. After the first halving in 2012, Bitcoin surged from around $12 to $1,150 by December 2013, an increase of over 9,000%. The second halving in 2016 saw Bitcoin rise from approximately $650 to nearly $20,000 by December 2017, an increase of over 3,000%. And this cycle has repeated itself every 4 years. But why does the halving have such a profound impact? The answer lies in the dynamics of supply and demand. This pattern suggests a cycle where, leading up to the halving, savvy investors start accumulating Bitcoin in anticipation of a supply shock. Post-halving, the reduced supply growth creates a scarcity effect. If the demand remains constant or grows due to increased adoption, media attention, or institutional investment, the price is likely to rise. Eventually, the market reaches a peak, followed by a significant correction as the supply and demand rebalance. The market then stabilizes, often at a significantly higher price than the previous cycle's lows, before the cycle begins all over again. Investor psychology also plays a role. Anticipation of price increases post-halving leads to buying pressure before and after the event. As prices begin to rise, more investors jump in, amplifying the upward trend. Bitcoin cycles don't just affect Bitcoin, they often set the tone for the entire market. When Bitcoin experiences significant gains, investors often look to cash in and then go looking for returns in alternative cryptocurrencies, leading to periods where alternative coins outperform Bitcoin. This phenomenon is known as the altcoin season. During these times, cryptocurrencies like Ethereum, Cardano, Solana, and Ripple's XRP, as well as others, will all see rapid growth. Market corrections are also part of this cycle. After dramatic increases in price, the market typically experiences large corrections when the price retraces back down. These periods can be challenging, but they also offer opportunities. So why am I telling you all this? Why is it so important right now? Well, this year in April 2024, we've seen another Bitcoin halving, but the timing of this one is absolutely critical. If historical patterns hold, we could have expected to see significant price movements over the next 6 to 8 months anyway. But this is just the start of the narrative, and there are some fundamental differences to consider for this cycle versus the previous cycles. We haven't even started talking about the most important factors as to why this technology will make so many millionaires in 2025. You'll have to keep watching for that. In earlier cycles, cryptocurrencies were the domain of individual investors and tech enthusiasts. Today we're witnessing a significant shift as major institutional players have entered the arena. Hedge funds, banks, pension funds, and asset managers, they're not just observing from the sidelines anymore, they're all actively investing in cryptocurrencies. Big companies like Microsoft and Tesla have started adding Bitcoin to their balance sheets, signaling confidence in cryptocurrency as a store of value. Donald Trump's even started talking about creating a strategic federal Bitcoin reserve in the US, and other countries have started doing the same.
The United States will be the crypto capital of the planet and the Bitcoin superpower of the world.
Traditional financial giants like Fidelity, BlackRock, JP Chase, they're all offering cryptocurrency investment options to their clients, or they're developing crypto-related services. This institutional adoption brings market credibility, increased liquidity, and the development of sophisticated infrastructure, contributing to the maturing crypto market. Crypto is no longer just a fringe topic, it's becoming part of everyday conversations in business and commerce. Payment platforms like PayPal, Visa, MasterCard, they now all support cryptocurrency transactions, allowing their users to buy, hold, and spend their cryptocurrencies with ease. One of the most significant developments in this cycle has been the approval and launch of cryptocurrency exchange-traded funds, or ETFs. ETFs allow investors to gain exposure to cryptocurrencies without having to buy and manage the digital assets directly or learn how wallets work. This is particularly appealing to institutional investors and individuals who prefer their traditional investment vehicles. This year we saw the first Bitcoin ETFs trading on the New York Stock Exchange. Since then, several other cryptocurrencies have either launched ETFs or are waiting for regulatory approval, including Ethereum, Solana, and XRP. For an in-depth breakdown of why ETFs are so significant to the market, you can check out some of my other content on the channel. The bottom line is this. This makes it easier for a broader audience to participate in the crypto market, bringing in additional liquidity. Regulation has always been a significant factor in the crypto space, but this cycle has been marked by more proactive and evolving regulatory approaches. Governments and regulatory agencies worldwide are increasingly engaging with cryptocurrency firms. In the United States, we've seen a significant shift in the outlook, with Donald Trump hailing himself as the crypto president and signaling his intent to appoint crypto-friendly figureheads at key positions and push through crypto-friendly policies, freeing the way for new use cases like stablecoins to be developed and regulated within the US.
Crypto is going to define the future. I want to be mined, minted, and made in the USA.
In Europe, the European Union has already developed a comprehensive set of regulations known as the Markets in Crypto Assets Framework, or MiCA. This creates uniform rules for all of the member states. In Asia and the Middle East, countries like Singapore, Japan, and the UAE have all embraced cryptocurrencies, establishing their own regulations. And even countries like China, who took a very restrictive approach to start with, including banning crypto activities, have started to change their tone more recently. Adding to these developments is the rise of tokenization. Tokenization is the conversion of rights to an asset into a digital token on a blockchain.
I believe the next generation for markets, the next generation for securities will be tokenization of securities.
Tokenization has the potential to revolutionize ownership and asset transfer by making transactions more efficient, transparent, and accessible. Real-world assets like real estate, commodities, stocks and bonds, and even intellectual property can all be represented as digital tokens, enabling fractional ownership and near-instant settlement.
And if we can have that distributed ledger that we know every beneficial owner, every beneficial seller, we all have our code of who's buying, who's selling, instantaneous settlement. It changes the whole ecosystem.
Financial institutions and technology companies are actively exploring ways to tokenize various asset classes. For instance, the possibility of stocks and bonds that currently settle over traditional exchanges to be settling over blockchain technologies is gaining significant attention. This would allow exchanges like the New York Stock Exchange and the London Stock Exchange to operate 24/7, reduce settlement times from days to minutes, and lower the transaction costs by eliminating intermediaries.
The entire bond market is being transformed as we talk right now.
The potential for more and more assets and asset classes to settle over blockchain ledgers is immense. I can't even begin to highlight the size and potential for this market's growth. Settlement on a blockchain reduces the risk of errors, lowers the costs, and increases the speed of the transactions. It also enhances transparency. Industries ranging from finance to supply chain management are all recognizing these benefits and are starting to settle transactions over blockchain technologies. The convergence of institutional adoption, mainstream acceptance, the availability of ETFs, evolving regulation, and the rise of tokenization sets this cycle apart from previous ones. With more ways to invest, such as ETFs, tokenized assets, and user-friendly platforms, a broader audience can now participate in this crypto market, which is going to bring additional liquidity to this cycle. And we're still so early in this market, which is getting more and more mature by the day, and it's only going to continue to grow in significance. The integration of tokenization into mainstream financial systems could be as transformative as the invention of the internet. It's such a critical time to pay attention to cryptocurrency and blockchain technology. This is going to fundamentally change how value is exchanged, recorded, and perceived across the globe. And again, we've still not even touched on one of the biggest reasons to be bullish in this cycle: the shifting global economic landscape and the initiatives by the BRICS nations to develop a new payment infrastructure. BRICS is an acronym for the 5 major emerging economies: Brazil, Russia, India, China, and South Africa. These countries have been collaborating to enhance their economic growth and increase their influence on the global stage. The BRICS alliance has expanded in 2024 to officially include Egypt, Ethiopia, Iran, and the United Arab Emirates, with many more countries actively applying to join the union. Collectively, BRICS currently represents about 44% of the world's population and roughly 37% of the global GDP, making their cooperative actions significant in shaping international economic dynamics. In recent years, BRICS nations have been exploring ways to reduce their dependence on traditional Western-dominated financial systems. This includes developing alternative payment infrastructures that can facilitate payments, trade, and investment among the member countries more efficiently and securely. They've been actively exploring alternative solutions to the SWIFT system. SWIFT is the Society for Worldwide Interbank Financial Telecommunication, which is the standard network used currently by banks for international money transfers. SWIFT is predominantly influenced by Western nations, and some countries view reliance on it as a vulnerability, especially when it comes to economic sanctions and geopolitical tensions that are driven primarily by Western countries like the US and the UK. By developing their own payment system, BRICS nations aim to enhance their financial sovereignty and ensure that cross-border transactions can proceed smoothly, regardless of the global political pressures. This new payment system, known as BRICS Pay, is being rolled out as we speak, giving a new unified platform to serve the BRICS countries and potentially other nations. And guess what? It's built on blockchain technology. It enables the BRICS nations to use their own local currencies for trade settlements, reducing the reliance on the US dollar. This shift could have profound implications on the global currency markets and may influence how international trade is conducted in the future. It could mean the end for the petrodollar. The BRICS countries have made huge developments in the area of central bank digital currencies, or CBDCs, with China, Russia and India already using a digital yuan, a digital ruble and a digital rupee, all of which are integrated into the BRICS Pay system. The adoption of blockchain technology by these major economies will accelerate the global acceptance of cryptocurrencies and clearly demonstrates how blockchain can revolutionize finance, beyond just serving as a platform for decentralized cryptocurrencies like Bitcoin and Ethereum. These developments have significant implications for the global economy. By creating alternative payment infrastructures and embracing digital currencies, the BRICS nations are positioning themselves to have greater control over their financial transactions and reduce exposure to external economic pressures. So just take a look around for a second. We've got the Bitcoin halving, we've got institutional adoption, we've got regulation, the introduction of ETFs, and the potential for tokenization. We've got the development of central bank digital currencies and live examples of new international payment rails being developed by the BRICS nations. There's so much opportunity in the crypto landscape right now, and we're poised for significant movements. There's a real opportunity here to create a huge amount of wealth, and we will not see anything like this again in our lifetimes. But there's also the potential to get wrecked in the process. Navigating this environment requires a clear, objective strategy. You need to remove all emotions from the trading process. There's going to be huge volatility along the way. Markets are going to shoot up, and then when they correct back down, they're going to be 20, 30, 40% price swings. You have to manage your risk and trade without emotion. That's where Aro Algo comes in. Aro Algo is a free trading software that you can use to build, backtest, and run automated trading strategies. It analyzes the market data in real time and executes trades based on the strategies that you've created. You can use the AI chat feature to tell it what kind of strategy you want to trade with. For example, give me a 4-hour golden cross moving average strategy with RSI, and the bot will build your strategy for you. The platform connects to your account with Binance, Bybit, Coinbase, MEXC, KuCoin, BingX, or whoever you trade with, and this allows you to manage your activities across multiple platforms from one single software. One of the standout features of Aro Algo is the ability to backtest your strategy. You can test how your trading scenario would have performed against historical market data, enabling you to tweak and optimize them before you run them in live markets. In addition to building your own strategies, Aro Algo offers a number of free pre-built strategies that you can customize. These strategies are designed by experienced traders and can serve as a solid foundation, especially if you're new to algorithmic trading. With Aro Algo, you can take all emotions out of the trading process. You won't get swayed by market hype or panic. It follows the logic and the rules that you've established, and when the corrections occur, you can rely on your stop losses and trailing stops, and you know that you won't get wrecked. Aro Algo also offers educational resources, including tutorials and webinars, to help you understand how to make the most of its features. Engaging with the Aro Algo community can further enhance your experience, as you can share insights, strategies, and experiences with like-minded traders. If you need help and support navigating Aro Algo, they have some great tools and resources on their website, and you can book a free personalized one-to-one session with me to help you navigate your way through it. You have a massive opportunity to create real wealth here in this bull cycle. Don't mess this up. If you like this video, then remember to hit the like button and drop me a comment down below. Subscribe to the channel for more content, and remember to always do your own research and thoroughly backtest any strategy before you run it live. Stay safe, happy trading, see you next time.